In this video, I want to share with you a trade I took last week where I made a $1,000 mistake. Your trading rules may be different, and that's totally fine. Regardless if you trade Ichimoku or not, the general goal of this video is how to deal with two situations. The first is when the trade is still open, price is moving against you, or something unexpected happens. How can you keep a clear head about you? The second is once we take the loss, the trade is over, but the emotions are still bubbling inside. Going forward, we have to find a way to not let it affect future trades. This particular instance is a bounce trade. Click up here if you want to learn more about it. Otherwise, let's jump into the charts and I'll show you what happened. I'm on the hourly chart for Euro NZD. Almost everything lines up. Only thing we need is price to close below the moving averages. This happens on the next candle. We have our bounce trade and I enter short. You can see my balance is a little less than 50K and I'm only risking 0.25%. I'm risking $123. My stop loss is 33 pips, which means I'm risking 376 a pip. So from here to here is $123. I'm trading short and the red candle is slightly below my entry, so you'd expect me to be a few dollars in profit. Much to my surprise, it's showing me at negative $91 already, or 75% to my stop loss. Trade was entered at 0:16 server time, or in other words, Wednesday at 5:16 p.m. New York time. No news at all was scheduled. Take a second and try to guess what's going on. As you're probably aware, spreads widen just before major news to protect brokers from increased volatility. This is the opposite situation. Every day from 5 to 6 p.m. Eastern Standard Time is what's called rollover, and spreads widen because of low liquidity. Every other time is overlap when one session closes. Tokyo overlaps with Sydney and London. New York starts in the middle of the London session. Now New York, European, and Japanese banks are closed. Sydney just opened minutes ago. It's true that futures and Forex are traded 24 hours a day, but the industry standard is to do system cleanup and maintenance at 5 p.m. New York time. Liquidity will be minimal, and then things will pick up about 6 p.m. That's the reason for the wide spreads. People react in various ways to stress. Some overreact and do something irrational. Others are like deer in the headlights. When I find myself in the thick of it, I try to just stop for a second. Take a deep breath. There's no point in me blaming the broker for the spreads or beating myself up for not noticing the time. None of that will change the fact that I just entered during rollover. Now, what can I do about it? There are two obvious answers. First option is I can close the trade immediately. I'll lose whatever open loss there is, but at least I won't be risking the full 1R and will save myself a little money if price goes up. Second option is I can do nothing. Come back to the charts at 6 o'clock and whatever happens, happens. There is a third option unfamiliar to some traders. I've played over 1 million hands of online poker, so it's very easy for me to think in terms of probabilities. It really takes a lot of the emotions out of it. I'm suggesting you do some mental math. Go with whatever option is better in the long run. If I close the trade now, I have a guaranteed loss. If I let the trade play out, sometimes I'll take a full loss and wish I cut the trade right now. Other times, price will go down. I'll be kicking myself for being so scared and lose money when I didn't have to. Going back to the charts, we see the next 5-minute candle moving around. Price continues to go in our direction, but because of rollover, we're about halfway to our stop loss. If we close the trade right now, we've accepted a guaranteed loss of negative 62.93. One has a definite outcome, the other is uncertain. We want to choose whatever is the higher expected value. But how do we do that? We know a few things. On a random candle, it has a 50-50 shot of going up or down. But this isn't a random candle because we just got a sell signal. So let's say price has a 60% chance of continuing down and 40% of going up. Now, let's talk about how far the candle could move. We already said spreads are wide because banks are closed and liquidity is low. What that means is we're more likely to see smaller than average candles. Two other things about rollover. Most of the maintenance takes place between 5 and 5:30. At 6 o'clock, spreads will be significantly better. So if I can make it another 30 minutes, I'll face much better conditions. Now price is below our entry and we're up 5.8 pips. Under normal conditions, this would mean we'd be showing a profit around $21. We're actually $63 in drawdown, which means the current spread is 18 pips, and we're only about 14 pips away from hitting our stop loss during the rollover period. Going back to TradingView, over the last 14 periods, the ATR, or how much a typical 30-minute candle moved, was 20 pips. This is an average, including the New York session, and we know the next 30 minutes is most likely to move less. Conceptually, it looks something like this. We expect price to go up 60% of the time and down 40%. Remember, in the trade, we're about 14 pips away from our stop loss, so look on the left side to see if we go past it. Don't really see it getting that close, so safe to say I'll still be in the trade 30 minutes from now. I don't want to get slipped 18 pips on a market order if I don't have to. Of course, in the heat of battle, we don't have time to break out the spreadsheet. So my thought process would go something like this. My trade idea is fine. I'm actually in a few pips of profit. The negative is due to the massive spread that'll end in 30 minutes. I still have a buffer until my stop loss is hit. Price is more likely to not move much up or down, and even if it does go against me 10 pips, I'll still be better off starting the next candle in drawdown than accepting a negative 0.5R guaranteed loss. That's what I decided to do. And as you can see at the end of the rollover, I'm only down $35 instead of $63. Entering during rollover was a minor mistake, but what happens next is what really cost me. I decided to use the faster moving average as my trailing stop. You can see that price closed above, so I need to adjust my stop loss. Here's a clip of another trade I took. I'm short and price also closed above the faster moving average. Now what I do is bring my stop to 10 pips above the wick. What I want you to notice is how methodical I am to measure the distance to make sure I give myself enough buffer. But this time the trade didn't work out. I have those 10 pips built into my system, and I've talked about it in other videos. How many times have you been right? Price barely takes you out and then continues on without you. Think of those 10 pips as insurance against a fake out move. Now let's go back to the Euro NZD trade and I'll show you the real blunder. As you can see, I misclick a couple times and move the stop loss without measuring. Price soon drifts up and I'm closed out. Going back, we see the 1 hour close above the moving average here. The high of this candle is 178.302, so a proper 10 pip buffer is 178.402. My new stop loss was set to 178.330, or only 3 pips above. The next candle where I'm taken out had a high of 178.333, or 6 pips away from where my stop loss should have been set, and I would have still been in the trade. It's the weekend and the markets are closed. Look at what's happened since then. Sad to say, I got out at the very top of the market. My initial direction was right and price shot right back down where it's currently sitting at 315 pips below my exit. At almost $4 a pip, we're talking about $1,200 difference in equity. Going back to the 10 pip buffer, I know full well I'm going to lose extra pips more often than not. But there'll be trades like this one that go for an extra 300 plus pips. This one trade could have paid for many, many buffers. I'm not a robot, and of course I'd rather win than lose. But if I lose 2 or 3 trades in a row, I'm not going to smash my keyboard or go off the deep end. By the same token, if I win 2 or 3 trades in a row, I'm not going to feel invincible and risk 3%. As long as I follow my system, I don't really care if I win or lose on the next trade. The reason I can say this is because I've back tested my strategy. I know over the long run, I should make money. As long as I stick to the rules, my edge should play out. But the thing that churns my stomach is making a sloppy mistake or willfully breaking my rules. In previous videos, I've back tested 3 separate trading systems and given you the exact rules. But I know that out of 100 traders, maybe only 20 will be successful. And why is that? We're all flawed humans. We give in to fear and greed. We want to get creative or think this one time we can get away with breaking the rules. We over leverage or we don't use a stop loss. Now that I've taken the loss, let's talk about how to deal with the aftermath. Most common scenarios where I follow all of my rules but still take a full loss. In those cases, 5 seconds later, it's business as usual and I'm looking for my next trade. I've already done the work and I know my numbers. I've shared charts like this before where I only expect to win 3 out of 10 times. I'll break even or take a sizable loss 70%, but my wins more than make up for it. Most of my trades are not going to be winners. So when I take a loss, I'm not surprised. It's just the cost of doing business. However, the trade from this video does not fall into that category. After I exited, there were several more bounce opportunities to get back into the trade. I didn't take any of these trades because I know in the back of my mind, even if I'm up on the new positions, I wouldn't tell myself I'm up this much. I'd be saying I cost myself this much. I trade 28 pairs, and one strategy I suggest is avoidance. If there's a pair that's still giving you a bad taste in your mouth, take it off your watch list until next week. The other 27 pairs for me are like blank slates. I can trade them objectively. But if I jump back into Euro NZD too quickly, I'm prone to a revenge trade in an attempt to get the money back. This might involve sizing up or jumping into a trade before all the parts of the system line up. When it comes to journaling, I'd say the simpler the better, or else you're probably not going to do it. The most important part of the journal is not what's happening on the charts, but what's going on in your head. This is what I would recommend. Go to TradingView, top right, and click on Copy Link. Open a new spreadsheet, paste it, and you can open the picture so you'll remember what the chart looked like. Now you want to write your unfiltered thoughts. I might type, feeling anxious. Already missed 2 bounce trades and price is moving without me. Maybe I want to remind myself that I already decided not to trade this pair the rest of the week, so I need to stop looking at it and ruminating. Thoughts I've had during this challenge. Do I really only need to be risking 0.25 to 0.5%? At this rate, it's going to take forever to pass. Or how about if I arbitrarily change my system and use a fixed 2-to-1 take profit instead of trailing my stop? I won't have so many losing trades and it'll look better on paper. I'm putting myself in the public eye. There's always the question of what people will think of me. The journal is for your eyes only, so you might as well be honest about what you're thinking and feeling. Thing I want to leave you with is to have a healthy view of yourself. If you break your rules and lose a trade, or even lose an entire challenge, that doesn't make you a loser as a person. You have value outside of the markets. Try to enjoy time with your friends or family. As far as trading, priority number one is to find a system you like, backtest it, and make sure it has an edge. The first tab of my journal would be my trading rules. I only enter when these specific signals line up. My risk management is this, and I must exit when this happens. The rest of the journal is the good, the bad, and the ugly. You can't fix problems you don't know are there. As you add more to it, certain patterns will begin to show up. If you're not sure where to start, I'd point you to my bounce video, which is the type of trade I took in this video. Let me know your thoughts in the comments below. Thanks for watching. Talk to you soon.